Imagine waking up tomorrow morning and realizing something is wrong. Your phone buzzes. You reach for it, half asleep, and open your banking app. It doesn't load. You try again, nothing. You shrug it off, probably an outage. You head outside. The ATM down the street has a piece of paper taped across the screen. Out of service. At the grocery store, the card reader beeps and flashes red. Cash only, the cashier says, not meeting your eyes. Gas stations won't take debit. Your landlord won't accept transfers. Your paycheck hasn't landed. And then you notice the streets. People standing in quiet lines outside bank branches that haven't opened. Shopping carts overflowing with food. Televisions in store windows blaring breaking news. The financial system is under emergency review. That's when the cold realization hits you. Your money isn't missing. It was never really there to begin with. It was just numbers on a screen, and the screen has gone dark. This sounds like the opening scene of a dystopian novel, but it isn't fiction. It's history, and it has happened in countries that believed themselves modern, stable, and immune. When banks shut down, life doesn't pause politely. It snaps. Argentina, 2001. At the turn of the millennium, Argentina was drowning in debt. Years of economic mismanagement, IMF bailouts, and broken promises had pushed the system to the edge. People sensed it. Citizens rushed to banks to withdraw savings, convert pesos to dollars, and move money abroad. The government responded with one word: Corralito, the little corral. Cash withdrawals were capped at 250 pesos per week. Dollar accounts were forcibly converted into devalued pesos. Overnight, savings meant for homes, businesses, and retirement lost half their value. Middle-class families, people who had done everything right, were suddenly trapped. They banged pots and pans in the streets. They protested. They begged, but the banks stayed closed. Money didn't disappear in theory. It vanished in practice. When bread doubled in price, rent became impossible, and jobs evaporated. Cyprus, 2013. A decade later, Europe learned the same lesson. As part of a bailout deal, Cypriot banks froze deposits. Accounts over 100,000 euros were seized, not taxed, not delayed, confiscated to rescue failing banks. This wasn't about billionaires. It was businesses that couldn't make payroll, retirees locked out of pensions, parents unable to pay tuition. The message was clear: when the system is threatened, your savings become collateral. Lebanon, 2019. In Lebanon, years of corruption and financial rot finally collapsed under their own weight. Banks imposed strict capital controls. Withdrawals were limited to a few $100s a month, regardless of account size. Savers didn't show up with paperwork. They showed up with guns. People weren't just losing money, they were losing faith in the very idea of citizenship. Even the United States isn't immune. In 1933, during the Great Depression, President Franklin Roosevelt declared a nationwide bank holiday. Every bank in America closed. For 4 days, no withdrawals, no wages, no certainty. It took government inspections and selective reopenings to restore confidence. Think about that. One of the wealthiest nations on Earth had to freeze its entire banking system just to survive. Why this keeps happening? Banks don't collapse because of bad luck. They collapse because of how they're built. At the heart of the system is fractional reserve banking. When you deposit $1,000, the bank doesn't lock it in a vault. It keeps a fraction, maybe $50, and lends out the rest. That loan becomes someone else's deposit, which gets lent again. Out of thin air, your $1,000 becomes $5,000, $10,000, more. This fuels growth, but it's also a house of cards. Because if too many people ask for their original money at the same time, the bank simply doesn't have it. That's why confidence is everything. The system works as long as people believe it will. Once that belief cracks, panic spreads fast, like a fire in a crowded theater. Who gets protected in a crisis? When panic hits, governments face a choice: protect depositors or protect banks. History shows which one they choose. Argentina froze withdrawals to save banks. Cyprus seized deposits to recapitalize institutions. The US shut everything down to stop a collapse. Banks and governments are inseparable. Banks need governments to enforce confidence, guarantee deposits, and backstop failure. Governments need banks to buy bonds, finance deficits, and keep economies running. When stress arrives, they close ranks, and the person left exposed is you. The illusion of protection. Deposit insurance sounds reassuring. In the US, the FDIC guarantees up to $250,000 per account. But ask yourself, if everyone demanded that guarantee at once, would the money exist? No. The fund holds only a fraction of total deposits. Its real power is not financial, it's psychological. It exists to keep you calm. What happens when banks shut down? Commerce freezes, payrolls fail, digital payments vanish, supply chains cease. In Greece, people stood for hours in the heat to withdraw $60 a day. Weddings were postponed, surgeries delayed, children pulled from schools. Money became a ration, not a right. And today the risk is even greater. We live in a world of apps, cards, and cashless payments. If the server goes down, if the account is frozen, your wealth becomes digits in limbo. A cashless society isn't safer, it's more fragile. The domino effect. Businesses can't pay workers, so layoffs spread. Supermarkets can't pay suppliers, so shelves empty. Investors panic selling assets at fire sale prices. What began as a technical decision in a boardroom becomes a social crisis. Bartering, hoarding, riots. This isn't speculation, it's happened again and again. And every time people say the same thing, this can't happen here, until it does. The uncomfortable truth. Banks do not exist to protect your wealth. They exist to protect themselves and the system they serve. When stress comes, they will sacrifice you to survive. Your money is only yours until the system says otherwise. A number on a screen feels solid until access is revoked. So what can you do? The answer is not panic. Stuffing cash under a mattress or emptying accounts in fear only makes you weaker. The real strategy is resilience. Diversification isn't a buzzword, it's survival. Assets in more than one form, more than one institution, even more than one country. Cash reserves, real assets, stores of value that don't depend on a server staying online. Real wealth isn't what you earn, it's what you can actually access when the system is under stress. The bigger lesson. Laws and safeguards are often designed to manage panic, not prevent collapse. Emergency powers, capital controls, deposit guarantees. They protect confidence, not citizens. If we don't understand this, we become complacent. If we do, we can demand better rules, transparency, and accountability. Final thought. Banks don't need to fail physically, they only need people to stop believing. The moment confidence cracks, the countdown begins. History doesn't repeat exactly, but its echoes are loud. From Argentina to Cyprus, from Lebanon to Greece, from the Great Depression to today. The lesson is simple. Do not confuse access with ownership. If your wealth exists only at the mercy of institutions, then it isn't truly yours. And one day, the question may not be, what if the bank shut down tomorrow, but what do I do now that they already have? If this changed how you see money, history, or the system we live in, subscribe, because the past isn't dead, it's warning us.